Good afternoon. Thank you for joining us today. Once again, I'm Bruce Tatters, CEO Red Cloud, and today we once again feature Seabridge Gold, premier gold and copper exploration development company that we see in the capital markets today. As I've mentioned many times, all of its projects are domiciled in politically secure areas of Canada and the US, and Seabridge ranks #1 in gold reserves and resources per share among all North American listed gold companies. We are extremely privileged to have Rudi Fronk once again here with us today. He's chairman and co-founder to provide a general outlook for the company. In particular, we're hoping to hear a little bit about the significant announcement around his financing in February that included a strategic player that we believe could prove significant with regards to KSM development. In addition to Rudi, we're also very pleased to have Jim Anthony, Seabridge co-founder, and we believe very well-known macroeconomic commentator with us today to provide both an outlook on the gold market and an update to investors on the events in the macro environment and their impacts on gold. As always, we begin with Jim's comments prior to Rudi discussing Seabridge. After formal presentations, we'll be taking questions live. Please send us your questions at any time via the chat, and we'll get to as many as we can. You can type your questions at the chat box at any time, including now. To start, we're just going to mention some disclosures for Seabridge. There may be some forward-looking statements on this call. I direct you to their cautionary note on page 2 of their corporate presentation. For Red Cloud Securities, I'd highlight this webinar is for information purposes only and should not be considered solicitation to buy and sell securities or a recommendation. We do note that everybody should take into account their particular needs and circumstances, and they should do their own investigations and seek professional advice before investing. And all of our most recent research on Seabridge has the specific disclosures as well. So now I'm going to turn it over to Jim and Rudi to begin.
Thanks, Bruce. Great to be back, and looking forward to not just our presentations, but also the questions that come. That, to me, that's the fun part. So, Jim, over to you on the gold market.
Well, we believe that the gold market, as we speak, is going through a complete reset. The old parameters of real interest rates and the US dollar are no longer driving the market. There's something new happening. So slide, please. To understand the reset, we have to go back to 1971. In 1971, the US defaulted on its agreements under Bretton Woods, and it closed the gold window. That was step one in moving gold out of the system and making the dollar as good as gold. The elements of a strong dollar policy are pretty well known. First, creation of the petrodollar, which was developed out of a series of meetings between the US and the Saudis, that they would accept only the dollar for their oil and they weren't going to demand gold. Paul Volcker, the Federal Reserve, played an important role in battling inflation. Ultimately, at an 18% interest rate, he got the inflation down and he destroyed the gold market along the way, which was part of the strategy. There was also an organized effort to get the European Central Bank allies of the Fed to sell their gold on a regular basis, which helped to discourage anyone who thought that it should be any higher. In the US, COMEX futures market was created in 1974. That allowed producers to sell forward on their gold, which some did in a very big way. It also allowed investors to trade gold without taking delivery and just basically trade gold for dollar profits. We also had a lovely little maneuver by the IMF to allow central banks to report their gold loans as if they were gold reserves. That came in 1978. And finally, in 1988, the final step, gold was declared to be a Tier 3 asset in the Basel Accord, which meant that it was equivalent to equities. It was not cash, it was not equivalent to sovereign debt such as treasuries. So next slide. The result of this was, as anyone could have predicted, Milton Friedman did, an explosion of unbacked financial assets and fiat money. The credit market grew from $398 billion to $102 trillion, which is a 256 times increase. The M2 money supply grew from 650 billion to 21.5 trillion, a 33 times increase. And the nominal GDP grew from 1.16 trillion to 30.3 trillion, only a 26 times increase. You can see the red line tells you what the credit market growth was as compared to the blue line, which is the economy in nominal terms. So obviously, credit was supreme. Next slide, please. So this had some interesting effects. On the left, you see the ratio of gold to the dollar. So what's the dollar worth in gold? Well, going back to 1971 when the gold window was closed, it was a little over 7/10 of a gram. And it fell directly and all the way to 1980, and Volcker turned things around a bit. You can see that there was a slight gain from 1980 to 2000. That's really the period of the strong dollar policy, but then fell thereafter, and it's now at 10 milligrams, 1/100th of a gram. And to the right, you can see another interesting chart. The blue line represents the increase in foreign ownership of U.S. sovereign debt. The yellow line represents the increase in the value of U.S. reserves, so gold reserves. So you can see that whereas it used to be that there was significant backing for the ownership by foreigners of U.S. sovereign debt, that quickly got totally out of control once the U.S. got off the gold standard. So next slide, please. We continue that thought with the slide to the graph to the left, where you can see that typically in the past, the market value of U.S. official gold as a percentage of foreign assets was running around 40%, sometimes considerably higher, now around 9%. On the right, another interesting way of looking at the explosion of financial assets. The gold price, the ratio of the gold price to adjusted monetary base has gone from about 3.1 at its high down to less than 0.3, as although the gold price may have risen during that time, the monetary base grew much, much faster. Next slide, please. So that gives you today's situation where gold and gold miners represent less than 1% of assets under administration. It's typically in the past, under the gold standard, ranging from 20 to 30%. Next slide, please. Now things are turning, and gold is returning to the center of the system. There's only so much dollar abuse that the markets will accept before things turn. And we can see it, first of all, in the BRICS oil trade, where in 2022, all oil traded in dollars. Essentially, that was it. In 2023, only 80% of oil traded in dollars, as the BRICS started to find other avenues for trading oil. We saw a number of policies that gradually destroyed the value of the dollar, starting with the global financial crisis, then turning to quantitative easing, zero interest rate policy, and finally the bailouts under COVID. All of these significantly weakened the strong dollar policy. Also, sanctions, which became a particularly important issue in 2022 when Russia invaded Ukraine. And that, again, these sanctions significantly weakened dollar confidence. U.S. deficits and debt have gone exponential. Of course, Some of that was COVID. It was supposed to come back after that, after the bailouts, but has not. And the result is that central banks are replacing dollar reserves with gold, and they have been, in fact, the largest purchasers of gold since 2022. And finally, Basel III, which is implemented in the US on July 1st after a number of delays, is moving gold back to a tier one asset where it's equivalent to cash and US treasuries. It requires now, or soon, no capital to hold physical gold positions as long as they're allocated. Next slide, please. So, looking at the fiscal incontinence, as I call it, of the U.S. Central Bank and Treasury, you can see on the left that U.S. expenditures, federal government expenditures, are the red line, which had a small comeback, a reversal at the end of COVID, but now has resumed its skyward journey. And you can see also the receipts, the blue line, falling further behind. So deficits have become an unsustainable story, as even Jay Powell has said. And on the right, the consequences. So global central bank holdings fell until 2010, and then the cumulative effect of zero interest rate policies and the growing deficit, which you can see on the left, and it's been straight up for central bank acquisition of gold since then. So that's the new environment. Next slide, please. So our conclusion is that gold is really substantially undervalued versus paper. Last June, we predicted a $3,000 gold price in a year, and we got it. We're now predicting that we're involved in a reset of the gold market. Only $20 trillion of above ground gold is backing $400 trillion in financial assets. And that $20 trillion of above ground gold includes about half of that is jewelry. It's not coming into the market anytime soon. Gold is going to catch up to the financial asset inflation now that it's moved back to the center of the financial universe. So we're indicating we see a $12,000 gold price within the next 3 years, which will take us back to a 40% coverage of foreign ownership of U.S. treasuries. And anyone who thinks that gold might be in a bubble should take a look at the chart below. It's there for fun, but this is the ratio of gold to SPX. It's now at a third of the level it was in 2011. So I think we can all relax. Gold's not going down anytime soon. So over to you, Rudi.
Thanks, Jim. So Jim and I launched Seabridge in October of 1999, and our goal was to create the industry's best leverage to the gold price by growing ounces in the ground faster than shares outstanding. And as you can see on this chart, we have delivered on that concept. From 1999 to 2002, we acquired a number of uneconomic gold projects in North America, including KSM. At that point in time, the majors were willing to sell projects with established resources for pennies on the dollar. In essence, as we came out of the gate with Seabridge, our shares initially represented an out-of-the-money, unexpiring call option on gold. Today, with all these ounces behind us and not a lot of shares outstanding, we still are an unexpiring call option in gold. However, with the increase we've seen in gold prices over the past 25 years, gold has gone from $260 an ounce when we started to over $3,000 an ounce today. The option value of our gold in the ground is now deep in the money. And I will put to you that right now in the current market environment, Seabridge Gold common shares are as mispriced as they've ever been relative to the underlying value of the assets we hold. We formed the company with the concept of building a company on per share metrics. We believe that most of our industry has lost that concept. Valuations and share prices go up based on per share metrics. If you look at the major gold mining companies over the past 15 or 16 years, all the big companies have diluted their shareholders by over 100%. Yet when you look at their production per share and the reserves per share, they have destroyed value in terms of decreasing production per share and reserves per share. The only company that seems to get it right is Agnico Eagle. And then if you look at the relative share price performance over the past 26 years, since the time we formed Seabridge, gold is up about 800%. Barrick is up 25%. Gold up 800%, Barrick up 25%. Newmont is up 135%. Kinross is up 78%. The only company that has actually outperformed the gold price in a meaningful way over the past 25 years, other than Seabridge, has been Agnico Eagle, with their shares up over 1,000%. We believe that the industry has destroyed shareholder value by diluting their shareholders and not offsetting that dilution with real value. When you look at Seabridge today relative to the industry, whether you look at us in terms of reserves per common share or resources per common share, we provide 5 to 50 times more gold ownership per common share than the leading companies. And that's why we believe over the long haul, we have significantly outperformed the gold price and other gold equities. And it's not about gold. We got very lucky, and I'll admit that this was luck. When we bought KSM, we bought it for its gold content. However, we've also found a lot of copper there. If you ignore our gold, if you ignore our silver, and if you ignore our molybdenum, and just look at our copper reserves and resources per share, we actually have more copper in the ground per share than the leading copper companies. Now we'll turn to KSM. KSM is by far the largest undeveloped gold project in the world. It's in a top mining jurisdiction located in the Golden Triangle, around existing, emerging, and past producers of gold. Our neighbors include Teck, Skeena, Newmont, and others. It's also located within regions of strong indigenous populations and local communities as well, which gives us access to regional workforce and supplies. One thing that sets KSM apart from a lot of our competitors out there is that we've actually gone through the environmental assessment process with permits in hand. And then more to the point, last year we were able to achieve what's known as substantially started, which means that the permits we now have in place are good and valid for the life of the project. This was a major de-risking we went through. To get to where we are today, we have strong support of the neighboring First Nations, including the Tahltan and the Niska Nation and other local communities. In fact, with the work we've done on Substantially Started, they've already received hundreds of millions of dollars in work from the work we did at KSM to get Substantially Started. Our Substantially Started designation was awarded in July of 2024. Unfortunately, a short few months after that, we've now had 2 petitions filed against the designation, which we believe are frivolous and we will be able to defeat over the course of this year. The first petition was filed by a group called the Tsawwats'kikamaha, claiming that the government was unreasonable in granting us this designation, and also that they were not properly consulted during the review process. The second petition was filed by 2 NGOs, again claiming that the government was unreasonable in granting us this designation. When you look at the work that we did on the number of fronts, the dollars we spent, the support we have from the larger Indigenous groups, and also from the local communities in BC Hydro, we don't think there's any way that a judge can look at this and say that the government was unreasonable in granting this. We are now in the process of putting together our responses to the 2 petitions alongside the BC government. Those will be filed with the courts in the next several weeks, and then we hope to get in front of a judge here so this ridiculous petitions can be put aside and removed. Another thing that we have going for us is the local infrastructure that's been put in place with other people's money. When we bought this project in the year 2000, there was really nothing there. Today, we have a major highway to the east of KSM. Along that highway, the government has built the power grid, bringing Northwest Transmission Line right past KSM. We've now secured 245 megawatts of power with BC Hydro, at which we're building our switching station so we can have access to power for early site construction activities. And then last but not least, to the south of us in the town of Stewart, we have 2 port facilities. one that's been for a while, that's been rehabilitated to deal with expected increase in production coming from the Red Chris mine, and a brand new port facility. Having roads, power, and ports in close proximity to KSM probably saves us a couple of $2 billion in capital that we don't have to spend because it's been spent by other people. Looking at KSM, we talk about this being a project. In fact, it's a district. If you look down in Chile, where you have a lot of the big copper gold projects in the world, they tend to form in clusters along a belt. At KSM, we actually have a district. We have 5 deposits, which collectively give us over 12 billion tons of economic resources. These 12 billion tons contain 160 million ounces of gold in all resource categories and about 58 billion pounds of copper. As we went through the environmental assessment process, although we have 12 billion tons of economic resources, right now we're permitted for a tailings facility that can hold about 2.3 billion tons. So we have focused our mine plans over the past few years on what is the best 2.3 billion tons to mine first to drive the best economics for the project. I think it's also helpful to look at KSM relative to other projects that might be out there, either owned by the majors today or not owned by the majors and available for the majors to sink their teeth into as they look for new projects to build. In terms of gold, KSM is the largest. In terms of copper, if you ignore the gold and just look at our copper resources and reserves, it's the 3rd largest undeveloped copper project in the world. What jumps out at me from this slide is how many of these projects out there are already controlled by a major in their portfolio. KSM is one of the few projects out there that stands alone, 100% owned by a junior company, in a world where the big companies are going to need new projects as we go forward. We've also done some significant de-risking of the asset over the past several years. To date, we've now spent about $1.2 billion Canadian on KSM. A big change for us was in 2020 going out and acquiring the East Mitchell deposit from our next door neighbor, Pretium. We bought this asset. It's gave us about another 34 million ounces of gold in the ground at a cost of about $3 an ounce. Off the back of that, we then went out and updated our pre-feasibility study to incorporate East Mitchell into the mine plan, which demonstrated a much more robust project and also a project that's far simpler to build as we eliminated the block caves that were in previous mine plans. The last box that we need to check now is to bring in a joint venture partner. We have made it very clear for a number of years now that this is a project beyond our capabilities to build and operate. We need a major mining company by our side to do that. And that's now when we think we can get that and finally get that done. I think it's important to look at what KSM has become as a result of the higher metal prices. If you look at the project that we delineated in 2022, at that time, after incorporating East Mitchell, we used a base case gold price of $1,740 and a copper price of $350. That project back then, again, focusing on only 2.3 billion tons of the 12 billion tons of resources we have, showed a project that had an initial mine life of 33 years, averaging over 1 million ounces of gold production a year and a lot of copper, and the all-in cost of production of about $600 an ounce, including all the upfront capital. If you change those numbers to today's spot prices, you see a project that shows very different project economics. You look at a project that has an NPV now, jumps from the 7.9 billion to well over $20 billion, a project that can show an all-in cost of production from 600 down to below $400 an ounce. But I think probably what the most important thing to focus on now is what this project generates during the important payback period of the project's capital. Everybody is worried about creeping costs in terms of capital costs and operating costs. If you look at KSM, when we did the base case study in the year 2022, the first 5 years of mine life generated about $12.6 billion of net cash flow. And that was against an all-in upfront capital cost of about $6.4 billion. So about 2 times coverage. If you look at the project today at today's metal prices, the first 5 years of production, instead of yielding $12.6 billion of cash flow, it's yielding over $23 billion of cash flow. So even if the capital cost of KSM were to escalate, let's say the capital cost of KSM increased from 6.4 billion to 8 billion, which would represent a 25% increase. At that capital cost, the project still generates an IRR in excess of 24% with this 2.7-year payback on the initial capital. Let's even go a bit further. Let's say capital went from 6.4 billion to 10 billion, which would represent a 56% increase in the capital costs. People will be surprised to know that the project still generates an IRR in excess of 20% with a 3-year payback on the initial capital. I would argue that given the major gold companies' need for replacing reserves, KSM stands as probably the one must-build project given today's metal price environments. So the question I get asked a lot is, okay, Rudi, you've been talking about a joint venture for many, many years, since essentially 2012. Why hasn't it happened yet? I think it's important to go back and look over time on things that we might have faced over the time period from then till now. One thing I will point out that to get the joint venture done that we look to get done at KSM, we have to have a lot of factors aligning. In the past, it has not been full alignment. We now believe that we're now at an environment where these factors are aligned. Going back to 2012, there was a lot of skepticism in the market whether a project like KSM could even get permitted in British Columbia. Well, we got our permits in 2014, but then unfortunately after 2014, the gold market collapsed. In 2011 or 2012, gold hit a peak of $1,900 an ounce. And then by 2015, the gold price had dropped to about $1,050. And the big companies were not looking at new opportunities. So we kind of got shunned aside. In 2018, gold had recovered. And at that point in time, activity increased dramatically in our joint venture discussions. In fact, we had 2 proposals that were received over the course of that year. But then unfortunately, the copper market collapsed. And a lot of those proposals were coming from the big copper companies. And the copper price dropped as a result of the Chinese trade war. Okay, let's go forward from there. 2020, things start to heat up again, but then COVID hit. Canada essentially shut down for 2 years. Travel stopped. And the big companies are more inward looking versus outward looking in terms of what could come next. And with Canada shut down, due diligence on the project was essentially impossible. Also during that time, we had a lot of companies that were engaged with us in joint venture discussions that were uncomfortable with block caving. Before buying East Mitchell, some of our production at KSM for the first 2.3 billion tons was predicated on building 2 big block caves. With East Mitchell, we were able to remove that. And by removing block cave mining from the mine plan, it definitely opened up the door again. And we were able to do that by buying East Mitchell from our next door neighbor. As COVID then receded in 2022, we created new PFS, incorporating East Mitchell with open pits only. New candidates emerged following that PFS, but then the challenge was, okay, you have a big project here, but your permits are set to expire in July of 2024. As a result of COVID, we were able to get an extension in our permits from 2024 to 2026. And then off the back of that, we went out and secured the capital to ensure that our permits will never expire by achieving substantially started designation, which was achieved in July of 2024. What I will tell you that with all the looking we've had at this project over the years by many, many major mining companies, both in the gold side and the copper side, we have not had any fatal flaws identified in terms of technical, economic, or social flaws. As a result of getting substantially started in 2024, 3 finalists have emerged as potential joint venture partners. Discussions are continuing. And as Bruce pointed out, we now have a strategic investor that came in on our most recent financing, putting $20 million into the project, which we're now advancing with them in terms of making sure that we have alignment as we go forward in the project development and opportunities that exist in front of us. So yes, it's taking a long time. We can talk about what's happened in the past, but on a go-forward basis, we are now confident that the window is now open to get a deal done. The activity we're seeing in the data room and in terms of joint venture discussions is fantastic. And also having a strategic investor in the deal that's aligned with us in terms of how we move the project forward to a production decision, I think changes the landscape dramatically. So driving value from this point forward, I would say that at today's metal prices, we are significantly undervalued. If you look at our NAV at today's metal prices, which is north of $20 billion, we're trading at about 5% of the in situ value of our reserves. Companies generally trade at 30 to 40% of the in situ value. So on a historic basis, our shares are extremely undervalued. Right now, at this point in time, we're seeing a big disconnect between gold equity valuations and the gold price. We believe that's going to reconnect at some point in time, the Western investor coming back to the space, and that's what's going to drive gold equity values to much higher levels. We have a 25-year track record of showing significant outperformance as gold equity markets rise and gold prices rise. And as Jim pointed out, we expect a much higher gold price, which should result in significantly higher share prices for shareholders going forward. Make no mistake about it, however, that the most important thing that we can do to drive value in the marketplace is to get a joint venture agreement done with the major mining companies. We think that the window is now completely open to get that done. And when that happens, and when we announce that joint venture participant, we think our share price is poised to go to levels of multiples of where we are today. So Bruce, back over to you for Q&A.
Thanks, Rudi. And as we've done in many of our talks together, I'll try and do my very best to organize the questions between Jim and then you, Rudi, back and forth. So Jim, you get the first one. Jim, there's a lot of commentary out there that beyond the Eastern influence and the central bank influence that has sort of been pervasive, what would you say, the last 15 to 20 months in the marketplace, that some of the more recent moves in the gold price is more of a cyclical view that the disruptions from some of the new U.S. administration policy is going to cause both economic weakness and potentially higher inflation, at least in the near term with all these tariff policies. So there's a lot of the question I've got is you're making a very different call here at $12,000 gold. It doesn't seem to be a call based on a short-term narrative of either weak economics and potential rate cuts down the road or pervasive stagflation type of inflation. So can you just explain what your thought process is?
Yeah, gold is an integral part of the financial system. And what we've seen is that all the other elements of that system have grown exponentially in terms of their quantity. The only way that gold can match that kind of growth in terms of value is through price, because the gold supply grows at about 1.4% a year, if that, although perhaps the higher prices will enable us to sustain that or maybe even raise it a couple of points. But that's the problem. There's just not enough gold to go around. And it is the only thing that backs all the financial paper that we've created since 1971. So that's the essential factor. The tariffs don't matter, at least not to the gold price. And they probably are not going to matter very much in terms of ultimately total trade flows and everything else. I understand that the U.S. wants to have more manufacturing. Their issue, by the way, is a very cute statistic, is that China has 13% of the world's population and 30% of the world's manufacturing. That's a little unfair, and they want to rebalance that. But it's going to be at the expense of the dollar. Scott Bessent, the new Secretary of the Treasury, has said as much. So, looking at the issue from the point of view of the administration's policy in wanting to have manufacturing and in wanting to therefore weaken the dollar, even though they'd like to keep it as the world's reserve currency. Good luck. It doesn't affect the fact that gold itself has to revalue in order to perform its traditional function as the only form of money that backs itself, and therefore the only form of money that can ultimately back all the financial assets and fiat that have been created since we went off the gold standard. It's a catch-up.
Okay. Rudi, next one is for you. It's off the questions on the thing. There are reports that BC has announced moves to expedite mining projects. Will this have a favorable effect on the Supreme Court docket regarding petitions challenging Seabridge's substantially started designation? And do you have any information regarding the timetable for the hearing?
Yeah, the timetable for the hearing is soon. We are now working with the BC government to put in our responses to the two petitions that were filed. That'll show that the government did do the proper consultation with the First Nation groups, not just the Nisk and the Tahltan, but also the group that brought forward one of the petitions, and that also the government is reasonable in their assessment in terms of granting us a substantially started designation. We expect to have those answers in for those petitions in the next few weeks. A judge will then be assigned. And I think it's safe to say that both Seabridge and the BC government would look for an expedited process to get a decision from the judge in the courts on that. In terms of the BC government moving forward, in terms of projects, the BC government has been supportive of KSM for a number of years. And what separates us from some of these other projects, we have our permits. We don't need a lot of new permits to go forward. We have the environmental assessment certificates, and we have the construction permits in hand that we've been using to get substantially started. It's great to see the government stepping forward, trying to expedite the permitting process. I will tell you, historically, from our perspective, permits are slow in coming. They take a lot of money, but if you persevere and have the support of the Indigenous people behind you in those permit applications, you will be successful at the end of the day.
Thanks, Rudi. Back to Jim. So Jim, there's been a lot of talk recently about the physical movements of gold and about whether Fort Knox visits are required. Listen, I could not possibly have a webinar where we didn't ask you your thoughts on all of these commentary that we've been seeing swirl around on physical gold and what you think.
Well, first of all, the movement of physical gold to the U.S. is quite extraordinary. Since the 1st of December, about 2,100 tons of gold have moved to the U.S., a lot of it from London, but from other places in the world as well, Switzerland, even Singapore. What's that all about? Of course, there are people who think that the U.S. is trying to replenish Fort Knox before President Trump goes up there to get a photo op. I don't personally think that's the case. The gold is very likely, in my view, still to be there. It's quite another matter as to whether or not it is owned outright by the U.S. Treasury without any hypothecations or loans. I think that's going to be more difficult to determine. So why do we have 2,100 tons of gold moving to the U.S. In the last 3 months, almost 4 months? And I think the answer is Basel III, that now or shortly on July 1st, gold will be a tier 1 asset, which means that you don't need to hold any capital against it. It's equivalent to cash. Commercial banks will be very happy to have it. And it doesn't count as a tier 1 asset unless you own it and hold it. So I think gold that has been out on loan is coming back to meet the opportunities of tier 1. And some of that may be, in fact, Federal Reserve gold that's being returned to Federal Reserve banks. But I do believe ultimately that the U.S. is going to be able to demonstrate that it does own the gold that it owns. If not, we'll get that $12,000 number a lot sooner than we think.
And that's July 1st, you said, 2025?
Yeah, 2025. It's only been in the process for the last 7 years. And by the way, still has not been implemented in the UK. That's not until the end of this year. It's clearly going to be disruptive because there's an awful lot of unallocated gold out there that is and should not be regarded as real gold. So the certificates, that people have bought from banks, where they assume that the gold is there, but it's really just a call on the gold owned by the bank. All of that is going to be brought to the test, particularly when these rules are implemented in the UK, and that's why they've been delayed.
Thanks, Jim. Back over to Rudi. Rudi, one of the things I wanted to ask you, I will get back to some of the questions online, but one of the things I want to ask you is, it's a real bifurcated market with regards to the gold stocks. The large producers out there, and even some of the mid producers have, I wouldn't suggest they're trading expensively, as sort of what Jim mentioned, but they are trading much better than the developers and the construction and the exploring gold stories. And any, like Seabridge, for example, doesn't actually have production right now. You seem, even though that you're the largest sort of developer out there on the markets, it really seems to be a big lag if you're not in production. And any insights as to what your thoughts are on this?
Yeah, I think it's quite obvious that as money now perhaps is coming into the sector, it's going to first go to the companies where a higher gold price is immediately impactful, like the Newmonts, the Barricks, the Agnico Eagles, and others. Whereas companies like Seabridge and Nova Gold and some of the developers, a higher gold price, yeah, the ounces in the ground are probably worth more, but you're not seeing that price anytime soon. I think also when you look at the disconnect between the bigger companies and the developers like Seabridge and perhaps Nova Gold, is right now the big companies are not looking at new opportunities. They're not looking at new projects to build. At some point, they're going to have to, because if you look at the pipelines of the major gold mining companies and even the copper companies, they need new projects. Now, as they generate significantly amount of new cash flow and big cash flow going forward at these metal prices, you can only buy back so many shares. At some point, you have to redeploy capital back into your future. And I think that's when you start to see the developers like Seabridge and others start to connect. It's interesting, if you look at our share price performance over the past, several months. First of all, I feel the pain that our shareholders feel. Believe me, our shares trading at these levels now with the work we've done and the value we can show on this asset is quite frustrating. I get that. I've got 95% of my net worth in Seabridge common shares. And over the past 6 months, that net worth has been about cut in half in terms of the market. Our share price was doing remarkably well after Nancy started designation. In fact, at one point in October, I think our share price hit above $20 US and about $28 Canadian. And that was a doubling from earlier in the year as a result of substantially started. We started to get some momentum in the market and also momentum in our joint venture discussions. And then a couple of things happened. First, Newmont came out with their Q3 numbers, and most of the producing companies are doing well going into Q3 with the expectation that higher gold prices would mean higher earnings and higher cash flows. Newmont's Q3 numbers stopped the market on a dime. They reported decent revenues, but their costs did not satisfy the market. And in one given day, Newmont's share price was down 15%. That impacted the entire sector on gold mining companies. And we started to go down precipitously with Newmont. We then had the petitions filed. The market does not like uncertainty. We had the first petition filed at the end of November, and the next one filed in early December. That has definitely impacted our market. But as I said, we think that they're frivolous petitions, and we will be able to defeat them over the next several months. And then last, I think the final piece was our financing. We went out and raised $100 million US, at $142 million Canadian, in a bought deal financing that will allow us to advance the project in terms of feasibility type activities with the support of a strategic investor that came in for about 20% of that financing. I think the market kind of read that. Well, if they're doing this big financing, perhaps it means that the joint venture is not going to happen anytime soon. And for those that were perhaps hanging on to the stock with the expectation a joint venture would happen quickly, with that financing, probably some of the air went out of the balloon then. What I will tell you, though, that we are as active as we've ever been in joint venture discussions. We have a strategic investors that stepped up to the plate, and we're working with that strategic investor to move the project forward in alignment. So here we sit at a share price of about $16 Canadian, $12 US on an asset that's worth many, many times above that on any historic valuation method.
Just while we're on this topic, Jim, I will get back to you, but I just wanted to do a follow-up off the screen here. There's two quick questions related to KSM, and since you've been rolling on that, Rudi, I just wanted to. There are two related questions. One is, what is the current capex estimate to build it? And second, based on your discussions with majors, what percentage of the mine do you intend to retain? I think they're very valid questions.
Very good question. So our capex estimate that's out there now in our 2022 pre-feasibility study is $6.4 billion US. Now that was before we started substantially started activity, so we've actually eaten into a portion of that. I will point out that when that capital estimate was made was at the height of inflation. Is there capital creep beyond that 6.4 billion? Perhaps, but it's not going to be a big number. And even if you start looking at what if the capital went from 6.4 billion to 8 billion, or what if the capital in a horrible situation went from 6.4 billion to 10 billion? At these metal prices, the project can easily withstand higher capital and still generate returns well above what we predicted in the 2022 pre-feasibility study. So anyone that's focusing on capital needs to also focus on the other side of the project, which is cash flow and costs. This project at today's metal prices, with copper at $4.50 and silver at about $32 an ounce, this project can produce an all-in cost of production at KSM of below $400 an ounce. Meaning that the ounces we have in the ground now, to think about in terms of option valuation, gold is at $3,000 an ounce, and all-in cost of production is about $400 an ounce, meaning that we have operating margins north of $2,500 an ounce. And today we're trading at about $6 per ounce in the ground valuation. So again, there's this big disconnect between the underlying value of the ounces we have in the ground and the cash flow possibility from those ounces relative to what our share price is.
Just a wee bit of leverage.
You think?
Not so much, just a wee bit. Jim, back to you. One of the things that was crossing my mind, I don't get as many macro comments, so you've got me always wanting to pick your brain every way, shape, and form. But one of the things when you were finishing up your discussion before on the physical state of the market, I know that you keep a good eye on the paper market for gold too, and I don't know where that sits these days. And if we run into a mid-year period where physical gold becomes a true asset, and there's a sort of a shoring up of that, where do the paper markets, the futures markets, stand these days? Are they net short? Are they net long? Like where are we on the gold market these days? I don't know.
In general, we could say that the paper market, that is looking at the open interest on COMEX, has been surprisingly low. Our largest investor continually looks at those numbers and is amazed at how little Western speculation has been manifest on the COMEX markets. We're currently, a little over 500,000 contracts. We've been up at 800,000 in past gold markets. So that's one thing. But what's a paper market?
That's right.
And COMEX is no longer a paper market, at least not as significantly as it has been in the past. 417 tons of gold have been stood for delivery in the last 3 months on COMEX. That's 15 million ounces of gold. People are buying and taking delivery. They're coming up with their cash. COMEX is slowing down the process of actually delivering as much as they can. But the fact is that the market is going physical. The next one that's going to be under that kind of pressure, and so far, we get hats off to COMEX. They've been bringing in enough gold to meet these requirements. But by the way, that's, that rate of delivery, standing for delivery, would result in over 1,800 tons delivered on COMEX this year. Every month has been a record, either for an active month or inactive month. So it's been extraordinary. But the next one under pressure is going to be the LBMA. there it's an OTC market. So there isn't the same requirement as there is in COMEX to deliver. Where you can have on COMEX expectations, there are exchange rules. The LBMA, it's, well, okay, we'll send you some gold. Yes, okay, we're going to honor your certificate. How about 8 weeks, which is what the current delivery period is, which really amounts to a kind of default if you're expecting anything reasonable. There's an awful lot of demand, pent-up demand in London, represented by certificates that are not allocated. Over 90% of all London gold is unallocated. So we don't know how much of that people actually want to have delivery of. But if they do, that's not going to be a paper market much longer either. So the world is going physical. It's in part because of Basel III. I give them credit. But the reality also is that in a world that's relatively unsettled now compared to the kind of world we've been in for the last 50 years, nothing is for sure. You want to have what you have. Now the Germans are fretting about the 1,300 tons of gold that they think they have at the Federal Reserve. But the last time they asked for delivery, I think it was a paltry 300 tons. It took them 7 years to get it. So I don't think this says much for the paper market. Get your physical. Paper's on the way out.
Interesting. London's bought themselves 6 extra months, just to shore it up.
Yep, that's essentially what's going on. And you know what? They could Welsh again on the rules. But we'll see.
We'll see as we get closer.
Yes, that's right. It certainly looks like the U.S. is going to meet their July 1 target, or we wouldn't have had the kind of movement into.
No, it seems like that seems like a fairly substantial movement, right?
I think we're there. 2,100 tons over 4 months. That's a lot of gold.
So Rudi, back to you. One of the last questions I've got here on the screen, and I'm going to just add a little bit to it. The question is, do you expect the joint venture deal for KSM will be concluded by the end of the year? I would just say, given the challenges in the court that you got to go through, is there a chance that gets in the way of concluding your deal this year, or how are you feeling on the timing?
I think when the petitions were first filed, that was probably a fear in the marketplace, why our shares traded the way they did. This must mean a joint venture is not going to happen anytime soon. I think anybody that looks at the details of these petitions and what they're asking can come to the same conclusion that we will, that they will not be successful. And I can tell you that the joint venture partners that we're in discussions with see the same thing. They see petitions that have been filed that are unreasonable, that will not have any chance of winning. To kind of put that into perspective, so the Tsawatskik and Maha, the one group that's challenging, they're a band of about 30 people, okay? If you look at the Niska Nation, the Tahltan Nation, and the Gitxsan Nation, all three of which supported the substantially started designation, the towns of Stewart, Terrace, Smithers, New Hazelton, BC Hydro, and you look at that population base, you're talking about tens of thousands of people that support the substantially started designation versus one group of 30 people that are opposed to it. They have to be able to demonstrate that the government is unreasonable. When you look at the specifics, the government was more than reasonable in granting us this designation. So I don't think that, and what we're, with our joint venture discussions, they view this as a nuisance the same way we do. It will be defeated, and it is not slowing down our joint venture discussions. We continue to move forward with our three finalists, looking at structure and terms. And our goal in a joint venture is the same that it's been over the last few years. We want to keep a meaningful stake in the project. We define that somewhere between 35 to 49%. We want to minimize our capital exposure in the project, not having to come up with anywhere near 35 to 49% of the capital. We're looking for a partner that has the technical, financial, and social wherewithal to advance this project to a construction decision and into production in a reasonable period of time. When you look at the cash flows that this project will generate right out of the gate, talking about $23 billion of cash flow in the first 5 years of production. That's over $4 billion of cash flow at today's metal prices coming out of the gate at KSM. If we can keep 35 to 49% of those profits, give us a multiple on that, and you look how ridiculously cheap our shares are at this point in time.
Thanks, Rudi. Well, there's one more little follow up to what I just asked you. Is there an appeal process in the event you guys manage to get the petitions dismissed?
There is an appeal process, but we'll cross the bridge if we have to.
Sort of like any appeals process, it gets less and less likely. And really, Rudi, just speak to the fact of the length of time it takes to get permitted in the mining world and in good jurisdictions where there's rule of law like Canada, and how difficult it is to bring projects on these days.
Yeah, so in my career, I remember getting projects permitted in less than 2 years or 1 year in third world countries when, it was more of a straightforward process to go through. In the case of KSM, we started the environmental assessment process in 2008, and we didn't get our approvals until 2014. So that in itself took over 6 years. Permitting takes a long time. I don't care where you're at. Permitting costs a lot of money. I don't care where you're at, but you're not going to get your approvals unless you have the local and indigenous groups supporting your applications all the way through the process. And then we are fortunate at KSM and at Seabridge that we have built these relationships with the Nisga'a Nation, the Tahltan Nation, the Gitxsan Nation, the local communities. And that's why we were able to take KSM from essentially discovery through engineering and permitting, and now in terms of early site construction to get that substantially started designation. It's the support we have from the indigenous people and the local communities that have changed the landscape for us.
Thanks, Rudi. Well, listen, we're coming up on the hour. I thank both of you for taking the time to do this webinar with us today. Rudi, I would tell you that I would be very excited to host a webinar if we're anywhere close to $12,000 an ounce on gold, so that you could run over your NPV and your IRR and your payback period at anywhere close to that. That would be a really fun webinar. But thank you both today for coming, and we really appreciate your time.
Thanks, Bruce, and appreciate everybody tuning in today. If you have any follow-up questions, shoot me an email. My email is rudi@seabridgegold.com, RUDI@seabridgegold.com. Thanks.
Thanks, everyone.